Hi, this is Jeng, and I'm here with Satya Masina today. We are out touring a property and just wanted to get introduced to Satya and just really give him a little bit about his background. So Satya, we met 5 years ago.
Yes.
And we were walking a little bit smaller property than the one we're walking today.
Yes.
But maybe give us a little bit about your background and sort of how you got into the business.
Yeah. Thanks, James. Thanks for having me. So I was an IT guy, been in IT for 20 years, and somewhere along the line, I wanted to be an entrepreneur, and I wanted to, all my research led to, investing in multifamily. I started with 8 units back in 2014. This is my 12th multifamily deal.
Right.
So a lot of great experiences.
Satya and I really met on a smaller deal that he was buying with his own money, and a deal that we used a recourse bank loan at the very beginning because you were just getting started.
Yes.
Right. And so met you out on the property, really just walked the property with you, and that was the first one. And do you remember how long did you own that first property?
About 20 months.
Okay.
And the one thing I would like to say is that it's not only, it's my first commercial loan.
Right.
And I didn't even know the difference between the recourse and non-recourse. And of course, meeting you, there's a lot of education that came along with that. And so since then, I think you and me have done a few recourse loans, and then I did a first Fannie Mae loan with you, and since then I think I've done 4 Fannie Mae loans,
okay,
about 2 Freddie Mac loans, and as I said, this is my 12th acquisition.
Right. So Satya really has done a great job of really not only buying properties for your own account. The last couple of years, you've jumped into more of a syndication model.
Sure.
And bought some larger properties. Maybe talk about the first one that you did, which was I think 100 units.
Sure.
In sort of North Dallas. Tell us about that property.
Yeah, and I think with me, James, the growth has come in slow and steady.
Right.
It has been an organic growth. So I've actually, I would consider myself more as an operator. So having operated, played around with my own money, and got my confidence, and then I first ventured into the 100 unit syndication. We've been planning to, as we have the experience, the next thing is to build scale, right? And that's where we went in and, identified a property in North Dallas. It's a 100 unit, 1970s, with a lot of value add. And then we're able to present it to the investors and raise. My first raise, we were able to finish the raise in about a week's time.
Right.
And I've been owning it since November 2019, and we delivered a complete, 8% return, slightly more than what we promised throughout the 2020, through the COVID times, because what we tried to do there is, under promise, over deliver.
Right. And so that was the first year in operation,
mm-hmm,
and you had owned the deal for less than 6 months, and then COVID hits.
Yes.
And so you had to be an operator, right?
Yeah.
So starting back in 2015,
mm-hmm,
you've had a chance to not only work with third-party property managers, but then you've also self-managed some
Sure.
of these properties.
Sure.
So talk about sort of how you decided to move into self-management and sort of how you've done that.
So initially, I didn't know any better. Self-management was the only option. But then later on, I did realize self-management is because once you learn the self-management aspect of it, and as you grow, you can actually always go to the third party.
Okay.
But the self-management experience gives you the core experience needed, even ask the right questions, even with the third party management. And basically self-management gives you 2 things, right? One is a deep understanding of your demographic, the tenant.
Right.
Okay, as I'm pushing the rent, what's the resistance I'm feeling? What are the other income opportunities out there? And then what are some of the practical situations in terms of someone, there's a fire, or there's a plumbing leak middle of the night, how do we handle all this? I mean, we don't necessarily have to to be a multifamily operator, it's nice to have all those experiences, and then based on the age of the property, you can anticipate so many, issues as you keep growing. And you can always delegate later on, with the property management, but at least you know what the core issues of owning a B and C properties and how to mitigate those. Those give us the depth of into the operations, and then make us survive, especially times like COVID.
So let's walk and talk a little bit,
sure.
And maybe go through. So this is a property that that you're about to that you're already under contract on,
mm-hmm.
but maybe talk about some of the things you look for in an acquisition, right? So when you're out touring properties, like a lot of properties are about to come on the market,
mm-hmm.
What do you like? What type of property do you try to find?
So first thing I would say, James, is that it's the location.
Right.
The location and the demographics, okay. All that matters. So I'm not so much into the, you want, a decent property or not so good property in a good location.
Right.
Because you can always improve the property.
Sure.
Of course, when also looking at the property, you can always transform anything as long as economics makes sense, right?
Okay.
So whatever improvements you're planning, whether it exterior, interior, does it all makes economic sense? Are you able to pull in the right rents? Can you achieve, because the location determines the economics as well, and the tenant profile and the demographics. So for me, it's not so much about is the property is in perfect condition? It doesn't have to be. It's the research part, which is primarily, as I said, the location, demographics, what the rent comps, all those factors, and of course the right financing aspect of it as well.
Right. So I mean, you've looked at a lot of deals,
mm-hmm.
and so we sort of take a look at, all right, what's the occupancy of the property? What's the size of the deal?
Mm-hmm.
How long do you plan on holding? So a lot of these deals, especially if you own it for your own account, you have flexibility.
Sure.
And want that flexibility. So we've been able to structure, some lighter prepays
mm-hmm.
on deals, and then some no prepay on some of these transactions. And so using that strategy where you haven't sat on deals for a very long time,
yes.
and just sort of let the equity sit in deals. You
sure.
sort of turned it over. I mean, I'm trying to think how many 1031s have you done so far? Or do you know?
About three.
Three 1031s.
1031s,
okay.
Yeah. Great point, James, because my hold as of now, in the last 5 years, my hold has has been under 24 months.
Okay.
Yeah, an average of 20 months. So a key aspect of exiting a deal is the prepay.
Right.
Whether it's a bank loan or a Fannie or Freddie, everything has a prepay. Fannie and Freddie has, do you want to go for yield maintenance, which is a lot more.
Right.
So far, I've been lucky to do a lot of step down prepayments, which didn't impact me that much. Even though in spite of paying that prepay, we were able to make significant returns. But what do I see right now is that the way the prices are, and you cannot expect the same rate of return as in the past glory is no guarantee to
right.
the future returns. So going forward, I might hold little longer, but I'm still only on my personal deals, I would still like to exit within 5 years or so.
Okay.
Yeah.
Let's go take a look at this unit as we walk here, and then maybe talk about what's the typical profile of the investors that you're working with in terms of limited partners?
So our typical investors are, IT folks, doctors, any other, small business owners. who are busy professionals, they have their own, either W-2 or their own business or going, and then they're always looking for, some additional income, or capital growth. So what we try to achieve for our investors is, cash flow during the property hold, capital growth, upon either refinance or a sale. And in between, we also try to do, tax benefits to them, doing bonus depreciation and so on. And we invest along with our investors to ensure that we have skin in the game and they're comfortable with, in investing with us. And, a lot of, typical question I do get is, real estate, like, they generalize us. And so what I tell my investors is that just like, we generalize a software engineer, right? And then within software, you have a Java or, DBA. Each one is a, a niche skill set. So people ask me, like, hey, why are you not doing, retail or office? The way I see it is that real estate is also a very general term. The way we see ourselves as we are experts in a, affordable housing, multifamily niche. So we don't invest in speculative real estate. We buy assets that are fulfilling a specific demand or a service in the marketplace, which is providing affordable quality, affordable housing. So we're in the business of affordable housing, and we are investing in assets which are underperforming, and then we try to value add, like bring it up to the market, and that's our niche, which is our core focus.
Let's talk about, we'll use this deal as an example. Mm-hmm. So this deal, you found it off market.
Yes.
And listing brokers are coming to you now with deals. They know that you can close. They know that
Sure.
You're not going to mess around and sort of get a deal under contract and not close. You're really out there, doing your due diligence up front and then really closing on the property. So take this deal for an example. Use this as maybe a template. Like, what did you see in this property as upside? What is your plans for the property, and how does this one maybe compare to some of the other ones out there?
Sure. So I've bought properties like, which fits into profile of this property, James, which is basically you have an existing owner who has owned it for a long time. Their basis is low, and they're not actively, doing rent comps and competing with all the newer build or, active owners. The rents, the current, demographic, the marketplace does support higher elevated rents, with some renovations and some upgrades, right? But what we have seen is that an owner who has been owning it for a long time, over time, they don't keep up. So that's where the value is. So we try to identify, such properties, and, as you said, like, in the beginning with brokers, you have to deliver what you say. If you keep performing, do your due diligence upfront, and once you identify a property, good or bad, like, keep moving forward. So this is again a classic example, almost like we have in recent times, almost 5 or 6 of our properties are off-market properties where brokers are bringing us the deals because we are able to deliver. So this is typically, what I see in this property is that this is a classic, beautiful townhome property built in 1980s. I would say, a B- kind of deal. So what we come in and do is upgrade the interiors, take care of the exterior, bump up the rents. And when I say bump up the rents, the market does support the bump up with the right upgrades. and then even try to outperform the market whenever you can. And then once you add the value, as I keep saying, this is not speculative real estate. Like, as you bump up your net operating income, the valuation of the property goes up, and when it is the right time, like, we exit and close the loop on that.
Yeah, and then, I mean, on this property, it's already, I think there's 3 or 4 vacant units on the property, and so it's 90%, over 90% occupied. So it's already qualifying for good Fannie Freddie non-recourse debt, and so that's really a key aspect. Is you're not putting short bridge loans or anything like that. You're really putting longer term non-recourse debt. You sort of fix the interest rate, take that risk off the table, and then really come in, add the value, and then on some deals you've decided, all right, I'm going to sell this deal. Other deals you've refinanced a lot of the equity out. And so talk to me about how you think about sort of exits, and when do you plan on exiting a property typically?
Sure. So as you said, multifamily, I mean, we not just the upside, right? Like, it's also depends on how much risk you're taking, and what multifamily offers to us, especially a property like this, as just like you said, a solid non-recourse, an agency debt, where you're bringing in 30%, bank is, I mean, the agency is giving you a 70%. So first of all, I mean, for the risk versus reward is, I mean, the risk is low, but the reward could be, good, so which is a good, I mean, thing, with the multifamily. As far as my exit is concerned, initially, like when I started off, I was in a W-2. So I have no need for, income stream. My primary focus was capital growth. So when you have when you add value and your property, goes up in value, you have to unlock that value so that you can deploy that money and reinvest and so on. So my thought process was initially, it's not like we don't have an endless pot of money. So I have to, exit, and then reinvest that money. That's the method but going forward, I feel that finding right deals, is getting hard. So now I'm, and also we reached a certain critical, mass where, it can generate some excellent, cash flow to us. So now going forward, it all depends on, the kind of deal, like, it's a nicer deal, I think we already added value. It makes sense to hold for the long run, then I will go and refinance. But if it's a, slightly a rougher deal, but there's still, money you can make through sale, I will decide on a sale. So I would say, it would be a case-by-case basis. So this would be a particular property, where, I might refinance and keep it for longer.
Right. So, I mean, once you've gone in, sort of done the rehab, improve the value, maybe do a refi, pull some cash out, and then just hold the deal for longer term. So we've talked about, sort of the exterior of the property. Let's go into maybe one of the units, take a look at the unit, and give the viewers a chance to see what a 1980s property looks like.
Sure, absolutely, yeah.